Hi, this is Colin Ritchie of Inbarrel Business Solutions. Do you think your business is running at its full potential? It's an interesting thought, isn't it? So what if your business could increase sales by, say, 10%? Now, if you could increase sales by 10%, potentially you'll increase your net profit by significantly more. So let's say 20%. Now, if profits increase 20%, then potentially that will increase your business valuation by as much as probably 40%. So what that means is a total return from that one increase of 10% in sales of a total of 60%. So that's the power of leverage in action. Let me explain further. Businesses are usually valued based on their future profitability. So what I mean is that a buyer will look at the business and say, are profits likely to continue at their current levels? Now, that profit is a mix of two things. Firstly, the owner's wage for running the business, and secondly, the return on the investment in the business. Now, mostly, a buyer won't pay you for buying a job, but they will pay you for the return on the investment in the business. So from that profit, they will then deduct a reasonable owner's wage to work out the return on their investment in the business. From there, they'll decide what payback period they want their investment paid back in. Then the valuation will be the return on investment times the payback period. Let me explain all that with an example. So we've got sales of $500,000, cost of sales, that's the cost of buying in the things that you sell, of $300,000, giving you a gross profit of $200,000. Then we've got overheads, things like rents and accounting fees and bank fees and so on, of $120,000, giving you a profit of $80,000. Now, in determining a value of that business, as I mentioned before, what a prospective buyer is likely to do is deduct from that $80,000 a reasonable owner's salary for working in the business. Let's say, for the sake of this example, that's $50,000. Then the actual return on the investment in the business would be $30,000. Are you with me so far? Let's say now that the buyer of the business wants to get their money back for their investment in 4 years, and that's a reasonable sort of period that you might expect. So in that case, what he would value the business at would be $120,000, or 4 times the $30,000 return on investment. Let's just think about that. If we could increase sales by 10%, like I showed you before, then what we would have is our sales would now be $550,000. Of course, there's a cost of sales. You've got those extra sales are going to have a cost related to them. So the cost of sales might go up to $330,000, giving a gross profit now of $220,000. Let's say, for the sake of this, overhead stayed the same. Your rent isn't necessarily going to change just because you're selling more of your product. So they're the same, but profit now has increased from $80,000 to $100,000. You start to see the power of that leverage, don't you? Doing our business valuation again, we've now got a profit of $100,000. Deduct that same owner's salary of $50,000, gives us a return on investment of $50,000. If we assume the same payback period, the value of our business has now gone from $120,000 to $200,000. Extra business value of $80,000. So in this example, that 10% extra in sales has given a great increase in profit and resulted in a significant increase in business valuation. Earn the extra profit and get paid multiple times. Sounds pretty good to me. How does it sound to you? If you want help in achieving this in your business, then contact us and let us help you. This has been Colin Ritchie for Inverell Business Solutions.